This is the Real Estate Investing Abundance Podcast. I'm your host, Dr. Allen. I know you're excited to get into today's show, but I have a very exciting announcement to share with you before moving to the show. We've just launched a complimentary and comprehensive webinar that, among other things, shows you how to legally use passive real estate investing to reduce your taxes, recession-proof your nest egg, and take the sting out of inflation. If you are curious to learn more, go to stevetucker.com/webinar. It is complimentary and only takes a couple of minutes of your time. Once again, that is stevetucker.com/webinar. I'll see you in the webinar. Enjoy today's show. Hello, enlightened investors, and welcome back to Real Estate Investing Abundance. I'm your host, Dr. Allen, and I'm looking forward into diving into the topic of how it is that we can unshackle and we can break free from the golden handcuffs of our lives. David McIlwaine is a seasoned entrepreneur and successful executive with deep experience in business growth, scale, and delivering results. His real estate experience is vast, spanning over 20 years. He has experience, knowledge, and understanding of having been gained firsthand by owning multifamily units, commercial retail development, asset management, single-family, vacation rentals, and second homes and custom builds. He personally wore golden handcuffs for about 14 years, then successfully gained sovereignty over his career and net worth by breaking away from that. He founded Mac Assets in 2019, and its portfolio currently includes property in the Southeast and Mountain West, and presently he is a general partner in over 1,000 doors. So David, share an experience that was key to helping you be who you are today.
Man, there's a lot of talking right there, huh, Alan?
Yes, indeed.
So I think one of the keys for me that made me who I am today is that when I was a freshman in high school, my father was laid off in Oklahoma in the oil bust of the mid 80s. And for listeners that are a little younger, they might not realize this, but that bust was pretty significant. It also precipitated the S&L crisis of the mid 80s as well. And if you were a mid-level executive, mid-level manager, it was hard to find a job. And I came home every day from high school and my dad was on the couch in a dark room watching old movies, hyper depressed. Yeah. I didn't realize what it was for years. Eventually, he was in the Air National Guard and he went back to work full time on active duty while he looked for a job and found one, and life progressed. But it was a really interesting series of events. What I came to learn was that as my father was laid off, 2/3 of the men at church were laid off. And I started to learn early on, there is no quid pro quo loyalty between employer and employee. And at that time in the mid 80s, the pension was really breathing its last breath before completely dying. And most folks that are in my generation, my generation really is the first generation that has no pension in its employment base. There are government pensions and there are some railroad pensions and teacher pensions, but in the macro, we have to do it ourselves. There were ads on in the TV that talked about if you don't have enough savings, you're going to have a miserable retirement. And that really influenced my life. As I look back on it now as a 50-something male and watching my kids go through high school and college, and having been through the same literal event where when my kids were young freshmen in high school, I too was laid off. You see a cycle and you learn from it. So I think that really affected me to create ambition and to no longer believe that something was entitled to me or due to me, and that the marketplace is fickle. I don't know. That kind of summed it up. I learned real quickly that you got to take care of yourself.
That is for sure. And we see the results of the dying of the pension. If you go to any fast food restaurant these days, 20 years ago, that was staffed with teenagers. Today, it is staffed with 65-year-old employees because they have no retirement.
Right.
And
And
so
the Walmart greeter job was created out of that.
yeah, exactly. Yeah, same thing. So, yes. So, well, you broke free of that and broke those fake golden handcuffs. So tell us about how you did that.
Well, it's kind of interesting because I was blessed early on in my career to have some really fabulous success. And I hit it out of the park on a 100% commission-based job. So I literally had handcuffs to where if I quit, I was miserable, but I was making so much money that I couldn't quit.
Hmm.
And I didn't know what to do. So I learned over the course of 15 or so years how to figure out that having the job that I didn't like, but making the money I really did like, there had to be some sort of balance in there. And there had to be a way to set yourself up for success to where at some point the wave will fall. If I was selling advertising and running advertising sales forces for a division of Viacom, and ultimately my job ended with a merger. And what I came to realize over this period of time was while I was wearing those handcuffs I didn't like, I didn't feel comfortable with, I built a strategic plan. And you see it and you hear a lot now in the real estate investing circles that you can quit your W-2. And I will argue, don't go down that route. It's not fool's gold, but it's a long and painful route. Instead, go down the route that says create freedom within the handcuffs you have. And if you want to leave, build the strategic plan to get yourself to where you want to go so you don't leave in a void. There's many different ways that we can create freedom inside of this. We can create freedom from financial uncertainty by making smart investments. And that's what a lot of us preach out here is make smart investments. Take money out of the stock market. Don't put all of your income and your 401k dollars and your company match all into the same employment. So if you're a J&J employer and you have employee and you have your 401k in J&J stock, you have your 401k in J&J performance, you have your income tied to how you perform selling J&J products. If J&J goes belly up, which won't happen, but as hypothetical, you're at risk. There's no diversity in that. So part of this is making a strategic plan, right? And then I think part of it also is recognizing there's more to life than working and figuring out how to work in a way that allows you to take control back over parts, setting boundaries. With the advent of the iPhone and the evolution from BlackBerry to iPhone and Droid and all the technological advances, we no longer have boundaries around work, and work from home now has taken away the ability to say, I'm not working during these hours and finding time to do things. So I think a lot of this is around creating what works for every individual plan and building the plan that works for you and your family. I don't know. I kind of went on a tangent there, but does that answer the question?
Well, that leads us to the other question, and that is what was your strategic plan and how long did it take you to put that together so that you were able to break free?
That's a great question. I didn't have the strategic plan laid out the way that I'm telling everybody else to lay it out. I had it in my head, and I'm doing that now because I've realized what I didn't do then.
Mm-hmm.
And sometimes the mistakes that we make are the great teachers, right? And maybe if I can help somebody not make the same mistake, that makes life a little better for them. In turn, it makes the world a little happier. In turn, life is better for all. So I had a non-verbalized plan to become a real estate investor. My spouse at the time was not on that page, and so there was a natural friction. But what I did do during that period of time is I made some really big investments for college. And then I bought small syndications because at this point in time, syndications were not nearly as prevalent as they are today. Syndications really became prevalent with the 2012 Jobs Act. And that really did allow for capital raising to less than a very specific core, I don't want to say elite, but it really was an elite network of people, right? And so I did a couple things before. I did some commercial stuff. I did some single family, and I played with it. I learned it. And I thought about my money as a stewardship as opposed to consumption. And so part of that plan is to get educated on what you want to do. Part of the plan is to test it. So I tested investments. Part of the plan is to figure out what interests you outside of the job that you may or may not like. So once again, that goes into more education, more soul searching. Then at some point, you have to just start doing. After the testing is done, you got to start doing. For example, I've got a partner in Cleveland right now who has a full-time W-2, and he's been doing the same thing every year. He buys a piece of property, pays cash for it, renovates it in cash, and holds it. And so he's building slowly and methodically. He's got an 18-door portfolio right now that's equal to his W-2 income. But instead of leaving his W-2 income because it's equal, he's going to get it to where it replaces. And that's what I'm talking about, is you don't just quit because you've balanced out the W-2 with the real estate. Then you never get a raise. So I think parts of this are figure out what's important for every listener. Decide what the freedom is you really want. Is it time? Is it energy? Is it travel? How do you do it? So if you want to travel, owning 30 single family rentals that you manage is pretty hard to travel because something happens. So then you got to build the systems. So that's a lot of what I'm preaching, is lay out a plan, customize it to what your needs are, and nobody's plan is the same. And that's what I did. I built a plan. My plan was, okay, I'm going to start doing several businesses. So I started a real estate brokerage business. I've started an investing business. And the capital that I was able to amass while working, instead of consuming, I was able to have usable for my goals. And I think that's a big part of it. We've seen time and time again, study after study says that someone's lifestyle creeps up to what their income is. It's a big discipline point. And I think that's a big part of the plan.
Yes, and that is, it takes discipline to keep that lifestyle from creeping up. And I think that's where a lot of people make their biggest mistakes. So you didn't follow this strategy that you are suggesting. That
Well, I followed
others
parts
follow.
of it, right? I didn't get all of it.
Parts of it, yeah, you didn't.
Right.
But you eventually got it all together, and were able to get out of that. How did you get it together?
Well, after I got laid off from my advertising job, I became a CRO for a tech startup. And 18 months later, I got laid off from that because the tech startup was 7 years old. And within a year of me being laid off, the tech startup closed its doors. So the marketplace rewarded that tech startup with a good piece of learning, right? So I found myself in the middle of a divorce as a single dad, and I had to generate revenue. My passions in education while in my golden handcuffed corporate job led me to real estate. So within being laid off, I became an agent in a couple months. I started jumping in to do residential investing. I then added in the element of residential real estate. From there, I bought multifamily. From there, I started scaling multifamily. So I really did a lot of the plan. I just hadn't executed parts of it. And I think when I was divorced and my spouse and I were no longer misaligned, I was able to follow the passions. And that's a big part of it, is that had I not gone through that education process while I was employed and while I was looking for things to do, I would have wasted time walking through the desert, so to speak, trying to figure out what it was and building the plan. So I had a plan in my head that wasn't codified. And I remember I went on a trip to the Grand Canyon and sat in the Grand Canyon Lodge, beautiful old lodge if you've ever been there, and got out my journal and wrote out the business model in about 3 hours. But it had taken me 10 years of research to get to that 3-hour product.
Enlightened investors, if you haven't done so already, be sure and click that like button and also click that share so others can take advantage of the content. And finally, be sure to subscribe so you don't miss a single one of our upcoming episodes. Well, you talked about a misalignment with a spouse, and I am sure that there are a lot of people that find themselves in that particular situation.
That's a nice way to say it, right?
You resolve that through divorce. Do you have any suggestions for spouses who are misaligned, how they can bring that into alignment in terms of We're talking
Yeah.
about investment, not
Yeah.
necessarily
Yeah.
everything in your
I'm not
marriage.
a licensed and marriage family therapist, right? I'm not going to go down that road. And I did not get divorced because we were misaligned on the investments. I wanted to be more of not a slumlord, but I wasn't worried about tenants, toilets, and termites. And she was very worried about having that impact our lives. And ultimately, her lack of embracing that kept me from taking action. So what I would say is when you're misaligned, one of the things that I did well then and I do well in my marriage now is that we talk out our goals and we figure out what the fields of responsibility are. And if the goal is to replace your W-2, it's going to take two of you to do it. If you're married, if the goal is to replace your W-2 and it's just you by yourself, that's a pretty simple thing. But if you create goals and the team isn't aligned, you can't score a touchdown. I live in Denver, so I'm going to talk about the Broncos or the Nuggets, right? And since the Nuggets are in the playoffs for the first time in the championship round, if you have one player that dominates the team and the rest of the team doesn't have the same goal, it ultimately doesn't prevail. It's no different in a marriage with investing. Investing is a business, and the job of a beginning investor is to get clarity around what they're trying to achieve. And the first time I bought a rental, I self-managed it. And I was a broker at the time, and people thought I was crazy to start managing my own as opposed to buying one and having somebody manage it and quote unquote teach it to me. And I thought, no, the only way for me to learn this is baptism by fire. And I learned a great deal. And I am very much aligned now on what goes on with people in the property management structures because I've actually had to raise the rents on people that were on fixed incomes. I had a tenant commit suicide one time. I've had theft. I've gone through the gamut. I've had police calls at midnight. I've had tenants alleging harassment on each other. So we learn all the scenarios. But with a misalignment of goals and an investment partnership with a marriage, I think the most important thing is like any other problem, you got to talk it out and you got to find a common ground and you got to find support for each other. So what I came to realize was that my spouse at the time did not support my vision. And it turned out that was indicative of some other problems. So maybe it uncovers a problem. And if it uncovers a problem, that's not a bad thing. If it uncovers a problem that you actually learn from, that's a good thing. And I hate to say this, but if it hastens or accelerates the divorce, that might be a good thing too. I'm much happier now than I was when I had my golden handcuffs and I was in a marriage that wasn't allowing me to go after my goals.
Yes, having been through a divorce myself, which at the time I thought that was the worst thing that could have possibly happened in my life. But as I look back on it over the years, I am so thankful for the divorce. My life before and after are entirely two different lives, and I'm so grateful that
Divorce
that came about.
Divorce does give you pain. There's no way around it. I haven't met a single person yet that wasn't divorced that didn't go through pain. But at the same point in time, divorce also allows you to do a restart.
Absolutely.
Yeah.
Absolutely.
And that restart allows you, dating in my 40s was a whole lot different than dating in my 20s. And it was a whole lot more honest because I knew who I was.
Yeah.
And that's not to say that dating in your 20s is dishonest, but everybody evolves and grows and changes.
Absolutely.
Yeah.
Well, David, tell us what you have to offer our audience and how it is they can take advantage of that.
Well, I do a weekly podcast called Break Your Golden Handcuffs. And we talk on there with different facets of life, performance coaches, investors, business strategists on how to create agency and freedom in your career. I've also published an ebook called How Ugly Apartments Deliver Beautiful Returns. And I think one of the keys to Golden Handcuff unlocking is that tax strategy is crucial. And I'm sure you've had many guests talk about tax strategy on here. And in the book, I go into a lot about what scale does. And that scale is shelter, cash flow, appreciation, leverage, and equity. And those all have impacts on your taxes. I was actually talking with a partner of mine yesterday. It's in Cleveland. And when I was making the really sick corporate money, I was paying about a 50% tax burden. And a lot of people today pay that or more. And if you're in certain states, your federal can be 35 to 40, and your state could be 10, and your municipality could be 5. It hurts.
Mm-hmm.
And I told my friend that if I hadn't been paying income taxes when I was making the money I would not be working, because that money, even post-divorce, would have allowed me to never have to work again. The tax money I paid. So tax strategy is an important part of it. And I talk about that with my listeners and my investors. And those are 2 of the products that I have out there. Obviously, I'm always looking to learn more and to share the knowledge I have. Having done so many varied things, I see that real estate is repetitive. And yeah, there's nuance and subtlety to every class, but in an overall macro economic structure, it's all the same.
Mm-hmm. And all of that that contact information is in our show notes. So viewers and listeners, you can find it there as well. Well, David, what is the moment of your biggest real estate failure, and how'd you come through that, and what did you learn from that?
Last year, I lost $150,000 in an earnest money deposit. Mm-hmm. We were under contract on a complex in Tallahassee, Florida. And the Fed started raising rates about 2 weeks after we went under contract. Mm. So this was last March, and the retail investor got very timid, and the rates changed. And from the time we went under contract until the time it fell apart, there were 3 rate changes, which equaled up to 225 basis points.
Wow. And
it was a falling knife. It wasn't about what I could have done different. We did finally find the investors, and the 1031 exchange did not materialize at the closing table. In the 1031, one of the 1031 partners decided they didn't want to invest in this, and it destroyed the entire 1031 exchange. So I learned several things. 1, earnest money risk is real. Losing $150,000 in cash is a reminder that when you put up risk capital, there's a reason it's called risk. It's not a sure thing. Mm-hmm. 2, the 1031 exchange system is very much a last minute Lizzie style model where people approve and disprove the transactions. And there's no reason for that. We should have had that exchange done a month in advance. And we were still doing it 2 days before closing. And that's not okay. Uh-huh. 3, sometimes you just can't control what the market does. And that's about as far from my personality as you can get. I'm about as much about strategic planning as there can be, but sometimes life gets in the way and you got to get up and learn from it. I actually wrote a blog on this on my website about seven lessons I learned doing this. So those are 3 of them, and there's 4 more if you want to go check it out. But that was a pretty bad day. And actually, it was the first phone. Yeah, it was the first phone call back from a week off on my honeymoon. I just got married last summer. So the first phone call back from my honeymoon was being told I lost this closing.
Wow.
And the seller said, "We're not going to give you an extension. We're taking your earnest money." It was $1 million in hard earnest money. So I only lost 15% of it. So we lost as a partnership $1 million.
Wow.
Yeah, it hurts.
No kidding. Wow. So what will you do differently in the future?
I pay a whole lot more attention to the Fed funds rate. I pay a whole lot more attention to the 10-year T-bill. I watch it now carefully. I have actually decided my acquisition strategy has evolved. I'm doing a little bit more smaller deals. I'm also doing some single family flips because those are simple returns of capital, and changing the way I approach the earnest money structures. The market's changed. We don't have to be as hard on the earnest money as we used to. And this was really kind of like the falling book of where when the Fed started raising rates, what happened. So those things are all action items that have come out of that. But I think the most important is recognizing that nothing is guaranteed.
That is for sure. We can plan for risk and all we want to, and there are just things that are just going to happen.
Yeah, and that's why it's called risk.
Yeah.
And academically and experientially are very different feelings.
Wow, absolutely. Yes.
Yeah.
In theory, everything works out perfectly.
Right?
Yes, in real life, it never does. So David, what is your big why?
You don't have to work forever. And I want people to know that. When I was in corporate America, I was the first person in my family that had real wealth, and I didn't know what to do with it. And I see people all around me that are trying to learn those lessons, and I want to help make it a little faster. That's the real why. Because as I look through it and I watch people around me, there's so much illiteracy around finance. And the financial education system is not there to teach us. One of the benefits of the internet is that we've unlocked the ability to share data and knowledge across marketplaces. I was in St. Louis yesterday. I'm sorry, I was in Cleveland yesterday. I'll be in St. Louis on Tuesday. I've got a deal in Kansas City. I've got a deal in Dallas. I've got a deal in Montgomery, Alabama. And before the internet, we couldn't have done the deals this repetitively and known the markets as well as we do now, because we have more information exchange, and that financial literacy has not accelerated with that. And one of the things I want to talk about is how people can approach financial literacy in a better way. And so the how is helping people make more money in a way that allows them to have more agency.
Oh, very good. Well, David, it's been a pleasure having you today. Thank you for sharing your life experiences and your knowledge and expertise.
Wonderful to be here, Alan. Thanks for having me.
Enlightened investors, wait, don't go just yet. I just want to remind you about our recently launched webinar that you will not want to miss. If you're at all curious and would like to learn more about how real estate investing can diversify your investment portfolio, alleviate the anxiety associated with Wall Street swings, leverage your 401ks and IRAs to substantially increase the return on your investment, and do all of this with turnkey, hands-off, passive real estate investments, then you'll want to immediately go to stevetalker.com/webinar. In the webinar, we'll also address the common dubious investment schemes that you want to avoid. To access the webinar, go to stevetalker.com/webinar. I look forward to seeing you in the webinar.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.